Hello and welcome to the show. I am Puneet Wadhwa and we have with us today Mr. Bhat, co-founder and director at Alphaniti Fintech. Welcome to the show, Mr. Bhat. So let me start off by asking you, the markets seem to be currently focusing on how global central banks, especially the US Fed, are fighting hard to tame inflation. So they seem to be missing the US Fed's balance sheet reduction plans as of now. So once that picks up pace, what is the likely impact you see on the global financial markets?
Well, I think the interest rate hike as also the quantitative tightening, as it were, or withdrawal of accommodation, in real terms will probably not dramatically different in terms of effect. Because even if you withdraw the accommodation, it is probably equivalent to something like about a 50 basis point further hike. But be that as it may, the hike has started first. The withdrawal of accommodation has started very slowly, just about under $50 billion a month for the last couple of months. And now we have reached, about 98 billion, $97.5 billion or something like that. So the effect is going to be gradual. And they've got to do this probably for the best part of the next 2 years in order to get to normalcy. So therefore, this would continue and probably it might continue at an accelerated pace. So therefore, I think the pain on account of that QT, as they call it, is probably going to be there for quite some time. And of course, even as far as interest rate hikes are concerned, we have not heard the last of it. There will still be further hikes. And given the fact that the US is already in recession, and the only point now is whether there will be a bounce back from here or whether it will get into deep recession. I think that's the debate going on now. And if the war continues and if there is a new flare up in the Taiwan Straits, I think deep recession is probably on the table.
For the next 2 years, do you think that the market is the bulk of the pain behind us now, or will they continue to muddle along? Because the past few sessions, we have seen a good rally in the global equity markets, including in India.
Well, I think because after a long time, after some negotiations, we saw some grain coming out of the war zone. So I think that is something that the market cheered. But at the same time, you had this visit by the US speaker to Taiwan, and there are some repercussions of that. So we do not know how far it will go. There are some missiles that have fallen within the Japanese economic zone and stuff like that. So therefore, I think if this is all contained and if the new war doesn't develop and if the old war sort of tapers down, then I think we are in for reasonably, we are getting into normalcy reasonably quickly. But if that is not the case, I think a deep recession is on the cards. And then I think things will be quite bad. And coupled with the acute quantitative tightening that we're going to see more aggressively as we go along.
On its part, the Reserve Bank also has outlined its strategy to combat inflation. Are the measures outlined in the policy announced recently what the markets expected? One. Two, do you think that the money will now move out from equity markets to safer zones like a fixed deposit, wherein there's an assured return and probably now it will not now be higher?
Well, I think the Reserve Bank has handled the situation quite competently, whether it is through accommodation in the past, quantitative accommodation, through liquidity accommodation in the past, and of course, recent couple of hikes that we have seen over the last few months. But I think even the latest policy has increased interest rates. But in fact, they are talking about inflation probably petering off from the sort of near peak levels that we are seeing now. So that being the case, we can probably see that India, if you see most of the statistics as far as India is concerned, whether it is GST collection, whether it is petroleum consumption, things are looking reasonably all right. The only problem that we have seen of late is that $100 billion trade deficit that we saw in the first quarter of FY23, which is a cause for concern. But I think if that is brought under some control, because the rupee has also has adjusted to this new reality quite well, and if that is handled well, then I think India would be seen as an island of growth, where we have serious problems as far as growth is concerned elsewhere in the world. So therefore, I think the Indian market will continue to do reasonably all right, despite the fact that elsewhere in the world, we have serious problems.
But don't you think that the possible hikes in rate by the RBI could dent demand?
Well, it would, but despite all that, we still have seen robust growth because we are coming from a low base. That is something that we have to appreciate. So with that low base, I think things are looking all right because economic activity, GST collection is the best indicator of economic activity, and that seems to be gathering steam. And if that gathers steam, I think the fiscal position would probably be slightly better than what it was envisaged earlier. And while interest rates would have some influence on demand, but that is not probably going to be very serious, because quite a lot of the inflation that was there was on account of supply constraints. And those supply constraints are being addressed. If you see the shipping shipping costs, they have come down dramatically over the last few weeks. And so if these things ease out, then I think raw material costs, input costs will come down, and that would probably, and even commodity prices have come off quite a lot. So all these things will ensure that inflation is probably under reasonable control, and even the hikes in interest rate might not be as steep as we initially thought.
Foreign investor flows have started trickling in. Will the good times last?
The fact of the matter is, if US interest rates continue to go up, and if the US is going to be, as it is in recession, but if it is going to get into deep recession, I think the global demand will sink. So when that happens, and especially coupled with interest rates in the US going up, generally, I think the global savings will gravitate towards the US. So that is a fact of life, and therefore emerging markets will probably find that they are not receiving much of the risk capital that they would otherwise receive. But having said that, while the flow of money into the emerging markets would come down, but India stands as I said, an island of growth. And so therefore, the proportion of money coming into India as a proportion of the total money coming into the emerging markets would probably be better. So on balance, I think India might still receive some money, but not as much as the robust flows that we saw a few years ago.
So how should investors build an equity corpus now? Are the large caps still a safer option, or the exposure to mid caps and small caps is advisable at the current juncture?
There is a huge uncertainty looming in the global scene between the Western world and the communist world, as it were. So I think that is something that we have to watch very closely. Given this sort of heightened uncertainties, I think it's much better to be in well-managed large caps than in the mid and small caps, because the mid and small caps require a lot more of research and a lot more of understanding of the business than the blue chips, as it were. So therefore, given the level of uncertainty, I would advise retail investors to concentrate on the big large caps, which probably can weather any potential storm much better than the mid and small cap stocks.
Any particular sectors that you find investment worthy at the current juncture?
Well, I think the one sector that has improved dramatically over the last few quarters has been banking and financial services. They've done extremely well. Even the June quarter results have been extremely good. So it is basically banking and financial services. They are enablers of growth in a manner of speaking in the economy, and they're in reasonably good shape now. I think that is one sector that one is to be invested in. Plus, of course, capital goods, infrastructure, these are good sectors to be invested in, because there's a lot more of investment that is going to come in modernizing the economy.
So on that note, we'd like to thank you, Mr. Bhat, for joining us today. We hope to see you soon.
My pleasure. Thank you very much.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
तुम इतना डर गए?
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.